Fiverr is a high-growth company that has put its investors on a wild round trip to nowhere since it came public. This stock soared during COVID. More recently, the bubble in this company's stock has burst and it's currently down 88% from its peak price in 2021. So is the thesis for owning the stock busted? I don't think so, which is why I'm happy to open up a starter position in this company today. Why? Here's everything you need to know about Fiverr. My name is Brian Feroldi.
And my name is Brian Stoffel.
Thanks to Common Stock for sponsoring today's video. As the time is recording, I am a shareholder of Fiverr.
And I am not yet a shareholder of Fiverr. Now, Brian, in talking about Fiverr, we need to remember this company at one point was worth over $10 billion, but today trades for just about $1.3 billion.
Fiverr's mission statement is to change how the world works together. This is simple, inspirational, and optional.
So how does it do that? Well, it is set up an e-commerce marketplace where businesses can find freelancers to get work done that they need, and freelancers can find customers for what they have to offer. The company calls this a service as a product model.
Fiverr has been in high growth mode for many years and is rapidly expanding its offerings. For that reason, spending on sales and marketing to acquire new customers is currently very high. We don't have a ton of data yet available to tell whether or not this service is recession-proof, but so far it looks to be recession-resistant. And since this is a marketplace business, the vast majority of this company's revenue is recurring in nature.
So what kind of moat does Fiverr have around its business? Well, the first and most important to investigate is the network effect. Here's how the company visualizes it. As more companies come to the marketplace because they demand quality work, more freelancers will join and get more value out of it by supplying that quality work, which only draws in more companies, creating a virtuous cycle.
That virtuous cycle is on full display over the last couple of years, but it's possible that there could be a chink in the company's armor right now as the number of active buyers in this platform has recently flatlined.
That said, the amount that each of those buyers spends has continually increased. However, the rate of that increase has tapered off.
Beyond the network effect, we do think there are switching costs in place both for buyers and for sellers. Once you get set up on this company's platform, it does become onerous to switch.
And we can see that by looking at cohort analysis. We see a contraction, usually followed by an expansion. This is to be expected. As new people try the platform out, some will stay, some will leave, but those that stay tend to spend more.
Beyond that, we do think that there is value in the company's brand name as Fiverr has become synonymous with hiring people online, although this is far from the strongest brand name we've ever seen.
Now, when you take into consideration the fact that buyers have flatlined and their spending has tapered off, we're going to say that the moat here is at least stable.
Turning to financials, Fiverr has been in high growth mode for many years, growing its revenue at more than 43% clip over the last 3 years. One thing to applaud about this company is that it's producing gross margins well over 80%, although it's not producing bottom line net income, at least on a GAAP basis.
But those bottom line losses aren't a huge concern for us. Why? Because the company has been free cash flow positive for quite some time, and it has a fair balance sheet. Now, once that net income switches, those returns on capital will also become positive.
Turning to management, we were pleasantly surprised to see that Micah Kaufman co-founded this business and is still the CEO to this day.
And he is leading an organization that employees love, giving it high reviews on Glassdoor.com, and he has a ton of insider ownership.
Turning to potential, we think that Fiverr has a fair amount of optionality built into its platform. If you look back at the recent history, this company has consistently rolled out new products and new services that open up new revenue opportunities.
Because that net income was so low, we have little doubt that there's a ton of room for the operating leverage to improve in the years ahead.
And the market for hiring freelancers around the globe is massive, coming in at more than $270 billion in annual spending, and that figure itself is growing rapidly.
And while the company has made some acquisitions in the past, the vast majority of the growth has been organic.
So how has this stock done for investors so far? The answer there is not great. The shares are actually down since coming public in 2019, although the company has consistently exceeded Wall Street's estimates on the bottom line.
And unsurprisingly, given where it is in its growth stage, it is not returning any cash to shareholders via buybacks or dividends.
Turning to risks, there are a handful for investors to keep in mind. First and foremost is competition. There are numerous competitors out there, the biggest of which is Upwork, but there are also smaller players such as 99 Designs and Guru. So far, Fiverr has had no problems attracting attention to itself despite that competition, but it would be a mistake to overlook it completely.
If we turn to Valuation, the company is handing out a lot of stock-based compensation, but it has been improving and should continue to do so moving forward.
Beyond that, there is some valuation risk that investors are taking on today, although it's far lower than it's been in the past. We'll have more to say about valuation in just a bit.
So let's turn to how the company did during the second quarter. Revenue grew 13% to $85 million, but that was lower than Wall Street and management were expecting.
On the bottom line, the company's earnings per share on an adjusted basis fell 37% to 12 cents, although that did outperform Wall Street's estimate.
Margins were down across the board, but on an adjusted basis, they all remained positive.
Free cash flow and net income both took a step backwards as the company ramped up its spending. On the flip side, the balance sheet remains in perfectly fine shape.
Now, when we look at the third quarter, management is expecting revenue to grow at about 10% at the midpoint. That's lower than Wall Street was expecting. And the company doesn't provide earnings, but Wall Street expects them to fall about 42%.
When it comes to the full year, this company has been pulling back on its guidance all year. In February of this year, management had originally guided for 26% top-line growth this year. However, they since updated that in May, and they were calling that to just 18% growth at the midpoint.
Well, then in August, they pulled the plug on that as well. But the new guidance is worth looking at. Top line growth is expected to just be 13%, but adjusted EBITDA is supposed to be higher than originally planned.
Essentially, this top line is not growing nearly as fast as management originally thought due to that short-term attrition that we saw and the stalling growth in active buyers. It's my belief that that phenomenon is temporary, but make no mistake, if I'm wrong about that, shareholders could get hurt from today.
So what is going to move the needle moving forward? Well, the first thing is to see those total buyers grow from the 4.2 million mark it's been sitting at for about a year.
Second, we want to see the company continue to swim upstream and get more spending from each of its buyers.
Third, one of the ways the company can do that is by increasing its take rate. That's the amount of each transaction that Fiverr gets to keep, and that has been moving in the right direction.
Fourth, keep an eye on free cash flow. We want to see this number remain positive and start to grow again.
So overall, we think that the Moat direction for this company is definitely stable.
However, we disagreed about the current state of the thesis. I believe that the thesis for owning this stock is on track, though there are some early warning signs that are worth watching.
And I believe that with users growth stalling and spending per client tapering off, that this is a yellowish green flag. There are some warning signs.
So how did Fiverr score on our investing checklist? The answer there is pretty good. For me, this got a 79, which is towards the high end of my investable category.
And on my framework, this got a 9, which is right in the middle of my robust investable category.
Turning to valuation, we believe that Fiverr is currently between phase 2 and phase 3, although keep in mind this isn't a perfect guide. So we think the company is not yet optimized for the bottom line yet. Rather, we believe that it is optimized for revenue and gross profit. For that reason, we think the price to sales and price to gross profit ratio are the most useful metrics at this point.
So let's take a look at those. On a price to sales basis, Fiverr trades for about 4 times sales, which is far less than it did, topping out at over 50 over the last 2 years.
Gross profit has continued to grow since this company came public, recently topping out at $263 million over the trailing 12 months. Given the company's market cap of about $1.3 billion, that puts this company at just 5 times gross profit, which I think is a very reasonable number.
We can also take a peek at a couple other metrics. Fiverr trades for about 45 times free cash flow. That's meaningful because this company is not optimized for free cash flow, and it is spending a ton on sales and marketing.
Fiverr doesn't have a trailing PE ratio, but it does have a forward PE ratio. That figure at 288 continues to look extremely high, but keep in mind this company is not optimized for earnings. I expect that number to drop meaningfully over the next couple of years as the company focuses on the bottom line.
So what do you think about our decision to purchase shares of Fiverr? Head on over to Common Stock and leave a comment in our display on this decision.
We're going to dig through your comments and highlight the best one, and whoever makes the most insightful comments will be paid $100 by Common Stock.
We want to give a shout out to Scoreboard Investor, who won the most insightful comment for our decision to purchase shares of Figs.
Common Stock will pay Scorecard Investor $100, so if you want a chance to win $100, simply head on over to Common Stock, leave a comment, and you'll be entered in the contest. So there you have it. I'm excited to make an investment in Fiverr today, although I do admit it is a company that is going through a rough patch right now. We hope you enjoyed this summary. Brian's out.